Hello, everybody. Ed Denny here. It's Monday, December 15th, and we have our first snow of the season here over the weekend. Not too much, about 5 inches, but enough to look quite wintry. The trees initially all turned white as the snow kind of landed on them. I'm not much of a poet, so I won't go any further into the beauty of the whole thing, but it really is quite a beautiful season. As long as the snow goes away after it arrives, I'm happy with that. But as you know, snow tends to linger because it tends to remain cold. So we'll see how that plays out. Just have to make sure not to slip on any ice. A lot of danger when it comes to that. But I'll be careful. Hope everybody else in this area just enjoys the season. Well, this is the season that we typically get Santa Claus rallies. And maybe we already have had our Santa Claus rally. The mark has been quite strong uh, since the beginning of the year. We're actually up 16% with a lot of volatility, obviously, in between with tariffs and Doge and DeepSeek at the beginning of the year. And now we're ending the year, I think, on a pretty good note for earnings anyways. The earnings situation has been absolutely magnificent for the first, second, and third quarters. Certainly better than analysts had expected. But that isn't unusual. It's just a lot better than analysts had expected. So the earnings story is kind of confirming that the economy must be in pretty good shape. And now, some people would quibble with that and say, well, the stock market's not the economy, and earnings aren't necessarily the economy. My view is that earnings are the economy, and therefore the stock market is to a large extent driven by the economy and, of course, valuation. But the quibblers would say that the quality of earnings is questionable. They're particularly focusing on the Magnificent Seven. The Magnificent Seven suddenly have become controversial until recently. It was kind of like Game of Thrones. That's the analogy I maybe pushed too far in the morning briefing today. But I did acknowledge that with the aid of Google's Gemini 3, I was able to kind of glue together an analogy between the Game of Thrones show and the Magnificent Seven. The Magnificent Seven, if you think about it, they had their own little kingdoms, their own little fiefdoms, and they really didn't get into each other's business. They all kind of had their own little monopolies. They had large moats around their castles, their fortresses, and they kind of respected those moats and seemed to be content just making lots of money with what they were known for. So, what were they known for? Well, obviously Google was known for search. Along the way, it's picked up Waymo, it's picked up YouTube, it's picked up some TPU chips, it's picked up Gemini 3. So it's no longer just a search. Maybe never was all about search, but that's where they made a lot of their money, and they were kind of the cloud provider as well. Software, I think that fiefdom belonged to Microsoft, certainly with the operating system and with major apps like Excel and Word. And then Amazon online retailing. They're still right up there in retailing. They have competition from Walmart. They have competition from Costco. But in terms of online, they clearly have been the rulers of their kingdom. But recently, Microsoft, which kind of has been working with the OpenAI company, OpenAI started to move in and kind of muscle in on the territory of Amazon because they're looking into ways to use AI to provide a online retailing experience for customers, and a lot of them are certainly Walmart. A lot of them are certainly are Amazon customers. who else should we mention here? Well, we should definitely mention Meta. I think that's basically advertising. Though obviously they're trying to get into things like metaverse and glasses and all that. The electric vehicles has been Tesla, which is all over the map with humanoid robotics. It's certainly become focused on artificial intelligence, spending a lot of money on creating a huge data center. And smartphones, Apple, and the GPUs is NVIDIA. So I think it's can be argued that they kind of didn't have much competition. Now, most of the focus on the Magnificent Seven of late has really been on issues like the way that they depreciate their GPUs that they buy from NVIDIA. They're doing it over 5 to 6 years. People like Michael Burry said that they should be doing over 2 to 3 years, that once the chips are used for 2 to 3 years, they become worthless. Others, including ourselves, would argue that's a bit of an exaggeration, that they certainly have a service life beyond that. But that's an issue. Then, of course, capital spending. These companies didn't really have to do a lot of capital spending. They had a tremendous amount of cash flow as their treasuries were getting uh, were swelling with all the coin of the realm that they were raising from their business. They were able to do that relatively cheaply with relatively small payrolls. But now they're spending a fortune on data centers, on capital spending. They're spending a fortune on personnel who are viewed as excelling in the AI space. And so they're certainly competing in the area of creating data centers, in the area of hiring workers, and increasingly competing with each other. So AI has really been transformative in all sorts of ways. But one of the important ways, in our opinion, is it's created more competition. More competition. Competition is always attracted to high profit margins, and these companies have operated with very high profit margins, and now they're kind of gunning for each other. And at the same time, there's no barriers to entry in the AI world, and so it's conceivable that somebody out of nowhere will suddenly come up with something better, cheaper, requiring less electricity than what the Magnificent Seven are currently providing. And wouldn't you know, at the beginning of the year, a Chinese company called DeepSeek came out of nowhere, and their announcement that they were able to create a large language model much more cheaply with less powerful chips than others had been doing, I think was a major reason why we had a correction at the beginning of the year. Tariffs were important too, but in terms of the Magnificent Seven, I think DeepSeek kind of really unsettled the Magnificent Seven. But wouldn't you know it, during first and second quarter earnings seasons, the Magnificent Seven companies made it clear that they didn't view DeepSeek as a serious competitor, that they still felt that they would need to spend a tremendous amount of money on capital and on labor, and that they intended to do so. And they reported decent earnings. And so the Magnificent Seven came right back from that kind of correction. Well, more recently, of course, what kind of unsettled the competitive landscape is Google, which was kind of viewed as a kind of a loser in this whole thing because AI would replace search very quickly. Well, Google came up with Gemini 3, and Gemini 3 seems to be better than ChatGPT. And so the ChatGPT, the OpenAI, Sam Altman responded that with a code red announcement, made it sound pretty existential. But in a matter of what, a few days, they've come up with a new version of ChatGPT, which is supposed to be competitive in some ways with Gemini 3. And meanwhile, DeepSeek just announced about at the same time that they too have a newer large language model. So this is a very, very competitive situation. it's very expensive. It consumes a lot of power, it requires a lot of chips, and these companies now are in much more competitive situation. As a result of that, we came to the conclusion that as we look at 2026, maybe it's time to consider that the Magnificent Seven might underperform for a while, and that the impressive 493 might outperform. And we also pointed out that information technology and communication services in the S&P 500 account for 45% of the market cap. They also account for about 35% of the earnings share. So it's not as though that market cap isn't supported by decent earnings share, but still 45% is certainly not consistent with the importance of all this to the economy. I mean, technology and communication services are not 45% of the economy. So maybe in that sense, the market isn't, or at least the S&P 500 is not fully reflective of the broad economy. Nevertheless, when we've been saying overweight information technology and communication services, we've been saying it for a while. We've been saying it since maybe the two of them were 20, 25, 30% market cap. Now they're 45% market cap. So when we say overweight these two sectors, we're saying you should have more than 45% of your portfolio in these two, and that seems a bit of a stretch. And so, kind of get more realistic, we just kind of went back and said, okay, let's market weight them, even though 45% is also in the grand scheme of things quite a heavy weight on just two sectors. But to the extent that you've been overweight and now going market weight, where do you put that extra money? Where do you rebalance? Well, you don't. What you do is you put more into the other sectors that have worked. Financials have been an overweight for us, so we would continue to overweight them. Maybe put more in there. The Maybe put more into the regional banks, for example, that have had a good run of late, but there's still some upside opportunity in our opinion, along with the overall mid cap world. Industrials, we've been overweighting the S&P 500, maybe overweight the industrial mid caps, which have done very well, and they continue to do well. We also decided that we haven't really paid much attention to healthcare. It's been basically by default an underweight for us, but we go overweight there. It's had a good run here of late, but there could be more in 2026, especially with biotech now doing extremely well, and it's doing well because of a lot of M&A activity, and with the government continue to put pressure on farmers to lower their prices. It's the government obviously isn't doing that to the same extent with biotech. So that's another reason for maybe their outperformance within the healthcare sector. With regards to looking at a global portfolio, we kind of said, well, if 45% of the S&P 500 in two sectors is a little rich, what about the U.S. As a market capitalization share of the MSCI All Country World? Well, it's up to 65%. And again, since 2010, we've been recommending stay home rather than go global, and it's worked really well. But that was when the US was more like 40% of the market cap of the All Country World MSCI. Now it's 65%. So does it really make sense for us to continue to recommend overweighting? I mean, do we really want to put 70, 75, 80% in the US and in a global portfolio? And the answer is that seems like a stretch. Maybe it's just time to declare some victory here or mission accomplished on that call, and be more open to the idea that there are opportunities in the global economy, and others, including plenty of investors, other strategists, perhaps recognize that for this year, and this year has been a very good year to overweight the rest of the world. Now, a good chunk of that was because of the weaker dollar. Last time I looked at it in local currencies was about a week ago. I think our MSCI is up 16% year to date, and the MSCI of the all country world, excluding the US, is up 19% in local currency. So that's not that big a deal. However, the dollar is down about 8 to 10%. And that obviously contributed to the return of having of owning stocks overseas and converting that to a total dollar return. I still don't see the dollar kind of going into a death dive here. I'm not in that camp at all. Uh, the When people talk about the dollar, they talk about the DXY, and the DXY, in my humble opinion, isn't a particularly good indicator of the dollar, is because it's 57% euro. So it's really more an indicator of what the euro's doing. The yen certainly isn't doing particularly well. It's been very volatile of late. Maybe if the Bank of Japan this week raises their short-term banking rate, maybe that will strengthen the yen. But meanwhile, fiscal policies uh, is continuing to step on the accelerator over there. So there's a real kind of clash between the monetary authority trying to tighten policy and fiscal authority trying to ease policy. So again, there's nothing particularly compelling about the yen situation. The euro. Yeah, again, maybe the euro is the euro situation is where the currency isn't necessarily the economy, but there are a lot of question marks about the European economy. But then again, it's a big economy, and one of the best performers has been Spain, for example. Their banks have done quite well, and so maybe there's more left in that trade. Poland has been one of the outperformers this year in terms of an emerging market. Um, Obviously, Brazil, Mexico have done well. China has done well. So there are certainly global opportunities. We don't do stock picking, so we can't help you in that regard. But owning some ETFs to go more global might make some sense. So that's our thinking of sort of sectors and global uh, balancing of portfolios going into 2026. We think the bond yield is going to continue to stay above 4%. The Fed just lowered the Fed funds rate for a third time this year by 25 basis points, 75 basis points altogether. And yet the bond yield is still right above 4%. The Fed has lowered the rates by 175 basis points since September of last year, and yet the bond yield remains elevated. So the Fed has been justifying lowering interest rates as becoming less restrictive. They still think they're restrictive because they think the neutral rate, or at least on average, they seem to agree that the neutral rate is something like 3%. So they think they haven't been really easing. They've been easing, but what they've really been doing is becoming less restrictive. They still think they're restrictive enough to bring inflation down to 2% sometime over the next couple of years, closer to next year. But while they've been easing, the bond market hasn't, or it certainly fought them last year. Last year, as we've discussed before, the bond yield went up 100 basis points as the Fed funds rate went down 100 basis points. So the Fed really actually eased back then. We'll about to find out here what's going on with the economy. Initial claims suggest that layoffs are actually decreasing. Initial claims have been pretty well behaved of late. Some of that may be Thanksgiving related. Things seasonals can get screwed up around that time of year. I think the real problem in the labor market is sort of a skills mismatch. Kids coming out of college with degrees and skills that don't really match what is needed in the economy. And at the same time, I think employers have really held off on hiring as they're trying to sort out whether AI really is an important productivity tool for them. I think on balance we'll find that it is. So once the assessments are over, I think it's still going to be a situation where it's going to be tough goings in terms of hiring, of seeing people getting opportunities. But speaking of opportunities, job openings still remain historically quite high. It's just there's this mismatch, as I said, between the kids coming out of school, colleges with the degrees they have, and what's needed. We also obviously have the very restrictive immigration now, and deportations having an impact on the labor market. But all in all, it looks as though the economy is still growing pretty decently. Atlanta Fed says something like 3.5% for real GDP in the third quarter after, what was it, 3.8% back in the second quarter. Meanwhile, the labor market numbers have gotten weaker. Jerome Powell said maybe they're even weaker than we're seeing. Well, if that's the case, then the productivity story is remarkably strong. And Powell did acknowledge that the economy is doing well because productivity is strong. But at the same time, he clearly indicated that he's concerned about what's going on in the labor market and used that to justify the latest rate cut, which apparently was led to quite a bit of dissension within the Fed. Uh, Before I hog the whole time here, let's look at a couple of charts here that I want to share with you. Uh, let's see, there it is. Um, it's PE times E, and the E side of the equation still looks pretty good. And E is the economy, in our humble opinion. Maybe E is getting somewhat exaggerated by the earnings quality of the Magnificent Seven, but the impressive 493's earnings are also doing quite well. And as you can see here, the forward earnings, which is a time-weighted average of this year and next year. So this is this year's estimate, which really doesn't matter anymore because we're merging very quickly here to the estimate for next year. So at the end of the year, the consensus estimates by analysts for next year, and the forward earnings obviously are going to be identical. And then we'll start showing you 2007, which is up here somewhere, 2027, which is up here somewhere, and we'll start to converge to that. So right now we've converged to $310, which is pretty impressive. At the beginning of the year, we thought 300. People thought that was a little delusional, but turned out it wasn't delusional enough. So in terms of thinking about where the stock market's heading in our roaring 2020 scenario, so we have the estimate at the end of this year's 310. Well, that's what we're using for next year. So that's the estimate for next year. That's what we're using for next year, 310. And then we pretty simply just go up to 350, 400, 450, $500 per share by 2030. 2030, of course, is the beginning of the roaring 2030s. But when we do PE times Z, we're looking at what the analysts will look up ahead here. So we just kind of take our forecasts, which tend to be optimistic, and the analysts tend to be optimistic as well. And so we just kind of move that 1 year backwards, and that's actually forward earnings. In other words, we posit that at the end of 2029, the end of the roaring 2020s, the market will be discounting $500 a share, which is what we think earnings could in fact be in 2030. So that's in our ratio scale. As you can see, maybe it's a little bit more aggressive. I mean, it's kind of consistent. Maybe it's a little bit steeper slope, but then it is a roaring 2020s, but it's not an off the wall kind of outlook. And again, this is the roaring 2020s. We try to account for the range of possibilities by saying, okay, let's take our numbers, but put a multiple range of 20 of 18 to 22. And so this is the kind of range we get. 7,000 to 5,400 would be this year, which is just about over. Next year, 7,700, 6,300. But we're inclined to be focusing on the top end of the range here. And by the end of the decade, we've been saying 10,000, which is kind of splitting the difference between 9,000 and 11,000. Why don't we open it up for a little discussion? I've covered a lot of ground. Yeah, we have had a pretty significant change in our thinking about where things are going, and that's partly because it was time to rebalance our ideas, rebalance portfolio suggestions. So why don't we take it away here? Let me see what I can do with that. Okay, so. Good morning. Are you able to, this is Matthew. Are you able to speak on the increased volatility in PEG ratios, especially in small cap in recent weeks? The dispersion between the mid and small cap indices piqued my interest. As always, we greatly appreciate your insights. Thank you, Matthew. I'd say that, the investors for a long time have wanted to believe that it's time for SMID caps to finally outperform, and it just hasn't happened. And now it seems that this latest rate cut has gotten the market more excited about SMID caps. Oh, there's Max. Um, and I would say that the outlook for SMID caps is good from a valuation perspective. We're still not seeing a real pickup in forward earnings, as we've been pointing out. The forward earnings story has been disappointing, and I think one of the reasons is a structural one, and that is SMID cap companies tend to that have really good earnings and good earnings prospects and have exciting technologies or products, services, doesn't have to be technology. They get bought up by the larger cap companies. The larger cap companies are always looking for opportunities to grow faster. Uh, in the past, the large companies kind of became mature and kind of stuck to what they were doing, and they didn't come up with anything particularly original. This time around, it seems that large cap companies, almost have internal investment banking departments. Not almost, some of them actually do, and they're always looking for opportunities to leverage up what they do already. And so maybe that takes all the fun out of the mid caps in terms of them small caps becoming mid caps, for example. Uh, this 2026 EPS growth for S&P 500, Europe, Japan, China, same for real GDP growth. Okay, well, we'll write that up. U.S. exceptionalism question mark. Yeah, I'd say that we still have a lot of areas of our economy, our society that are exceptional. Chip, considering Dr. Copper's PhD in economics, what are your thoughts on basic materials in 2026 with favorable earnings trajectory? Yeah, I mean, it kind of started with gold and then silver. Silver's taken off, beating gold. Somebody's yapping away here. Oh, that's Bailey. Um, Bailey, you're just going to have to wait. Um, and so Dr. Copper's at a new record highs. So is gold, so is silver. A lot of this is precious metals that's kind of now showing up in basic materials. We're seeing tin doing very well, nickel, not yet. So it does certainly suggest that notwithstanding tariffs, the global economy is held up remarkably well. And rather than talking about deglobalization, maybe we need to consider that globalization is being rebalanced as well. And when you put it all together, the global economy is still doing just fine. So yeah, I've got no problems with owning copper. Michael, do you have any advice regarding how to refute the arguments by bearish investors that the market is due for a crash? Uh, Look, there's perma bears and there's perma bulls. I've been accused of being a perma bull, and I've told you this before. I view that as a compliment. I want my tombstone to say Ed Yardeni was usually bullish and usually right, and I'm not bragging. I'm just saying that I've been trying to side with the market, and the market doesn't have recessions don't last very long in the economy. Bear markets don't last very long. Corrections don't last very long. And at least in our investment lifetimes, I think certainly with the benefit of hindsight, corrections in bear markets have turned out to be buying opportunities, and that's kind of been my shtick. Still working on calling tops. I think I've had a pretty good record at calling bottoms, and I've confessed to you that I've got a relative that I don't get along with very well. We don't talk very often, but at bottoms, this relative always calls me up like we're best friends, and he says, "Eddie, should I get out at the bottom here? Should I get out here?" And I said, and well, I try to be objective, and I say, well, maybe not. And then I look at the bull bear ratios, and they're under one, and I said, this is probably the bottom. But the perma bears will get you out at the top. They'll get you out in the middle, and they'll get you out at the bottom. Uh, they just don't like the market. They're not going to get you into the market. We're going to do our best to keep you in the market, and on balance, that's worked. So I don't know if that's the kind of argument you're looking for, Michael, but it's kind of based on the practical experience of the bulls versus the bears, especially the extreme uh, bears and the extreme bulls. I don't think I'm an extreme bull, but I do tend to be bullish. Um, and then, just tell them the roaring 2020 story. We've been writing about that for a while here. So it's worked out so far, so good. For those who think that we're due for a crash, then they're really saying we're due for a recession. Though I want to be careful about that because it's conceivable here that the market could crash for one reason or another, and that could cause a recession. Some people view that as what happened in 29, 30. I don't view that at all as what happened. I think the market took a dive in 29, recovered half of what it lost, and was back to where it was. By May of 1930, it was back to where it was in April of 1929. That's not a crash. That's just a buying opportunity. But then what really caused the great crash, where the market took a dive of 80%, was the Smoot-Hawley tariff, and that's what caused the recession. So I don't really see a situation where the market crashes while the economy is doing okay. Um, okay, Dilk, what are your thoughts on the demand for long-term U.S. bonds, and could this be an issue for an overall economy? Yeah, I am thinking that maybe 2026 is going to be the year of the bond vigilantes. The bond vigilantes are already doing their job in Japan. They've been doing their job in the UK. Here, not so much. Bond yields will stay down. And I think it's partly because it's reasonable to expect in the roaring 2020 scenario that inflation will continue to come down on productivity. The US remains exceptional in that people still view our securities as relatively safer than others, particularly our fixed income securities. Stablecoin is going to increase the demand for bills, so maybe the Treasury will be able to ease off on borrowing in the bond market and could do more of it in the bill market. But I'm going to stick with the view that bonds somewhere between 4 and 5% is kind of their trading range. And right now it's probably more like 4.5%. I'll take a couple more. And then, are you saying that foreign markets are going outperform the U.S. market on both earnings and real GDP growth, even with the fairly strong earnings and real GDP growth that you are projecting for the U.S.? Give us the 2026 projections S&P total return. Could you explain that more, please? Okay, that's going to obviously require some work and some paragraphs. I don't have the time to do it here, but the base. I think what overseas stocks have going for them still is they're cheaper than the U.S. The U.S. is kind of expensive. We've outperformed to a large extent because of the Magnificent Seven. Now I think that there's going to be less of that. Um, I think the impressive 493, maybe they will be magnificent, but the impressive 493 are certainly a good place to invest here in the U.S. And I think selectively, and as we saw this past year, there's opportunities in the global economy, and it doesn't have to be technology. Financials have done very well overseas. Communication services have done very well. They've got big growing populations over there, as one of my accounts reminded me recently, and They are going to create. They are aspirational, and they want to have a better standard of living. Okay, last question here. Speaking of crashes, have you read or have any opinion on Andrew Ross Sorkin's new book? Interesting. I haven't read it so far, but I will. I do have it on my audio pile, and I will uh, try to get through it before the end of the year. I did reread Galbraith's book on the Great Depression and the Great Crash. And Galbraith's book was a big hit. Still very accessible and readable. But there's one paragraph in there where he says, well, how big was this? How big a deal was this? And the answer seems to be it really wasn't that big a deal when he's talking about the Great Crash. He's saying that a very small percentage of Americans actually played the market. I mean, clearly there was a lot more interest in the market, and more people were playing the market. But in terms of percentages, it was a pretty minor percentage of the population that was involved in the stock market. And I'm wondering if Andrew address that question, and I'll be looking for that, and I'll share with you what I find once I get in there. So look, I will keep plowing on here. If you're in the mood, I'm in the mood, and we'll get together again on Monday. Yardeni Research will be taking a couple of weeks off around the holidays, at least in terms of morning briefings. But I enjoy doing what I'm doing. It's kind of a hobby, so I'll be doing this next Monday, and I'll also probably be badgering you with some quick takes along the way here, to the extent that important things occur. And they always do during vacations, of course. Just when we want to relax and kind of tune it all out, the world continues to go on. Well, again, thanks for tuning in. Let's do this again in a week. All the best.